This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, CIO, and Cameron Passmore, CEO at PWL Capital.
Welcome to episode 376, and this week we welcome back longtime friend of ours, Nick Maggiulli, who has a new book out, The Wealth Ladder. Terrific book, terrific framework. I thought the conversation was great. Now, we've known Nick a long time. He was first on episode 255 when his first book, Just Keep Buying, came out. And that was a great conversation. And we keep in touch with Nick fairly often, so it was great to see him again.
It is great to see him. And like you said, we've known Nick for years. When we recorded with Barry, however long ago that was,
7 years
we
ago.
met Nick in New York City at their office.
Yeah, and they're much smaller. And he says at the end, they jokingly call us the Ritholtz of the North. We got to know Barry and Josh and Nick and then the people at Ritholtz right there in Midtown Manhattan. And you're right. Remember that day we visited Barry in the office with microphones, and boy, that was early on.
So Barry said something. He made some offhand comment about how he has a studio at Bloomberg and he couldn't imagine schlepping all that equipment around. We were like,
we show up in backpacks.
Here we are schlepping the equipment. Oh yeah, it's funny. Anyway, yeah. So Nick sent us copies of his book. He wrote a very nice note in the front cover for in the one I got, and I'm sure same as yours, Cameron.
Yep.
And it's an interesting book, an interesting way to think about the progression of wealth over the life cycle and how people can move from. And as Nick said I think he said it during the conversation, but he definitely said it before we started recording, that the buckets are somewhat arbitrary. He's talking about the concept of the wealth ladder, which is moving up different levels of wealth, and how decisions about spending, time use, investing change as you move up those different rungs on this wealth ladder. But the ladder rungs, the specific numbers that you attach to them are somewhat arbitrary, but just the general concept that decisions change as the amount of wealth that you have at your disposal increases, I think is a pretty interesting idea. And Nick talks through how some of those decisions change, and also his observations based on looking at a bunch of US data just on like how the composition of wealth changes over time, which I think is interesting. In very broad terms, because the data he has are not super specific, but in very broad terms, what types of behaviors get people from one wealth ladder to another, like whether income or spending is more important to move
up and down.
Up and down, yeah, that's right. What leads to extreme wealth? Like he says, what gets you up to level 4, which is the $1 to $10 million rung, is not going to get you up to level 5. So just those kind of ideas. I think it is an interesting framework. So I enjoyed reading the book, and I think we had a good conversation here with Nick.
So we mentioned the 2 books he's written. Nick is the chief operating officer at Ritholtz Wealth Management, which he says is now a 70-plus person firm. So hats off to the Ritholtz gang. He's also author of the weekly blog of dollarsanddata.com, which, as he puts it, focuses on the intersection of data and personal finance. I mean, he is a data nerd, self-professed data nerd, which is kind of a great framework and certainly resonates with us and our audience. Anything else to add, Ben?
No, I think that's good. I think it's a bit of a change of pace relative to talking with an academic about their research, but I think this is super practically useful, and I think Nick has a lot of interesting insights.
All right, he's a good guy. Let's go to our friend Nick Maggiulli.
Nick Maggiulli, welcome back to the Rational Reminder Podcast.
Thanks for having me back on, guys. Appreciate it.
Super excited. We talked new. I did enjoy reading your book. Read it a couple of days ago. It was good.
That's great. I appreciate it.
All right. So Nick, what is the wealth ladder?
The wealth ladder is a new framework for thinking about building wealth that basically argues that your financial strategy should change over time. And when I say over time, I really mean as you build wealth. So kind of as your financial situation evolves, the thinking around the decisions you make in terms of your spending, your income, your investments should change as well. And so how it does this, it breaks wealth into 6 distinct levels, and this is all in US dollars. I know you guys are Canadian, so I think we can probably just use the same translation for Canadian dollars and it's probably close enough, even though the exchange rate's a little different. I think there's a slightly less wealth in Canada than the US, so it probably actually maps decently well. So in the US, these 6 levels are: level one is less than $10,000 in net worth. And by the way, this is net worth, so it's, all your assets minus all your liabilities. So less than $10,000 is level one. Level two is $10,000 to $100,000. That's level two. Level three is $100,000 to $1,000,000. Level four is $1 million to $10 million. Level five is $10 million to $100 million, and level six is $100 million plus. And the thinking behind this, obviously it's a log scale, so everything multiplied by 10. If you just memorize level three is, $100,000 to $1,000,000, and then you can just go up by multiplying by 10 or go down by dividing by 10. And that actually divides the United States pretty nicely in terms of the distribution. About 20% of households are in level one. So that's, less than $10,000. 20% are in level two, which is 10,000 to 100,000. 40% are in level three, which is kind of like the, middle class in the United States, I would say, which is 100,000 to 1,000,000. And then you have 18% of households in the United States that are in level four. That's $1 to $10 million. And then the top 2% is level five and six. And level six in particular has there's 11,000 households in there. It's a very, very elite small group that are in that 100 million plus range. And there's only about 30,000 of those people in the world. So the US has about a third of all the centimillionaires. But from that, you can just start to see wait, so my income decisions might change across the ladder. My spending decisions might change. My investment decisions or how they're allocated might change. And we can get into all of that.
So why do you think this concept of ladders is so important?
I think the idea of a wealth ladder has been talked about for a very long time. People just say it oh, you're climbing the wealth ladder. It's just a common concept that's been thrown around. I've at least seen it in the literature in terms of just how people talk about this thing. And I said, okay, why don't I actually define this? Why don't I try and make it into a real thing? I'll come up with levels, I'll come up with different strategies that have to fit within each level, etc. And so that's kind of where I came up with it. I just realized that financial advice should change over time. Yes, there's a lot of great strategies. You can be hey, just, buy a globally diversified index fund, save money. That's going to be a great strategy for most people. And that's going to work for probably 60 to 70% of people. But for some people that are deeply in debt or something, they need a different strategy. And for those that are trying to really build extreme wealth, it's not just the S&P 500 is not going to get you there by itself unless you have a super long time horizon or a really high income, right? And so I think realizing that there's other strategies out there and just thinking about this more holistically is what kind of got me to this point.
What is the 0.01% rule for spending?
So the 0.01% rule basically states that you take your net worth and you multiply by 0.01% or divide by 10,000. And that is roughly how much your wealth should generate on a daily basis. That's my assumption here. And if you actually do that, 0.01% per day, which is about 1 basis point a day, that ends up being 3.7% a year, which is a more conservative 4% rule. It's a 4% rule in disguise. And the idea here, the goal isn't to say, hey, you should spend 0.01% of your net worth every day. It's when you're making that marginal spending decision, if that marginal spending decision is less than 0.01% of your net worth, then don't worry about it. It's almost like a triviality rule, right? So let's say you have a net worth of, $1 million, right? That means that all else equal, your net worth should be going up by about $100 a day, conservatively, right? So if you're at a nice restaurant and you're oh, do I want to get this salmon or the burger? And the difference in price is $10 or $20. Who cares? It's less than that $100 amount. Just buy the thing and don't worry about it again, right? Buy the thing you want, right? If you want the salmon, assuming, right? So the whole purpose of this rule was I'm trying to allow for lifestyle creep. Because I think right now there's the personal finance community, the only real argument I hear is oh, no, you can't let your lifestyle creep. You have to keep your spending the same no matter how much you make. Yes. And I think it's a little strong. I want to allow some lifestyle creep, but only after you've built wealth. So it's hey, I've done the hard work. I've saved this money. I've invested it. I've built this financial base. And as that base gets bigger, you get to spend a little bit more over time, right? And so that's the assumption behind it. And I think it's very conservative. Of course, I'm not recommending someone spends, 0.01% of their wealth every day. But if you're doing this on occasion, it's not going to be a big deal. And so That's how I tried to solve the problem of allowing some lifestyle creep, but only after you've demonstrated the financial discipline to get there.
I'm curious, Nick, if you have some examples as people really climb up the ladder. Like, do you have some idea of examples of how spending decisions might really change as you climb?
Yeah, I mean, I think if you think about the big spending decisions most people make, it's going to be like in a handful of categories. It's like your house, your car, how often you're traveling, where you travel to, right? So you start thinking about these categories, and I mapped all these categories onto the different like levels on the wealth ladder. So for example, in level 2, which once again is $10,000 to $100,000 in wealth, once you're in level 2 and by the end of level 2, you have what I call grocery freedom. So when you're at a grocery store, you're like, okay, the difference between, buying one item versus the maybe more premium version of that item is going to be anywhere from like, let's say $1 to $10, right? And that's where level 2 is, right? If you take, $10,000 times 0.01% is $1. $100,000 times 0.01% is about $10. So that marginal choice, like, can I afford to get this nicer version of this thing at the grocery store? Like, yes, you can once you're at the end of level 2, right? And then when you're in level 3, I call that restaurant freedom, because now once you're at a restaurant, you can kind of buy what you want by the end of that level, right? Level 4 is what I call travel freedom. That's where you can start to, okay, maybe I'll buy a slightly nicer seat on the airplane. I'll stay at a nicer hotel. And then it goes from there. I think level 5 is where I say house freedom, where you can basically get a house almost anywhere you want. Now, not any house, but like by the time you have 10 million bucks, you can basically live in any neighborhood. And so you can kind of just go from there, right? As you start seeing your wealth just increase through these levels, like the spending categories change, and thinking about kind of the level of freedom you have. And of course, this is never like, this is not a perfect metric. I'm just trying to come up with like rough ideas of thinking about this. Like if you were in level 4, like you just start getting travel freedom. It's not like, okay, I have $1,001. Now I can go crazy. Like it's like, no, you probably still fly coach. You probably still are staying in a cheaper hotel. Maybe once in a while you can like upgrade something slightly. But as you get deeper into level 4, let's say you're in like halfway through, you're like 5 million bucks. Yeah, you can probably stay at a nicer hotel. You can get a nicer seat on the airplane, right? And I think that's the thinking behind it, is because you've shown the financial discipline. So the reward is more spending, right? Versus
Mm.
what most people do is they say, oh, your income's gone up a lot. Now you can spend more. And I don't like that, because income's fickle. It comes and goes. Like imagine an athlete, like an athlete has like a 5-year, they have a 5-year career. Yeah, they have an insane income. They could spend a ton of money, but like once that dries up, they have no wealth to, at the end, like what happens, right? And I think, there's always that cautionary tale of athletes that go broke and things like that. And I think it's because they spent based on their income, not their wealth.
Hmm. So it's really it's a framework for how much you can spend, but it also gives people a license to spend once they reach certain levels of wealth, which, to your point earlier, I think is a problem for a lot of people.
Yeah, and once again, the whole point of this stuff, it's not that this thing is perfect. It's like I've had so many people have problems with spending money, and they're like, "Oh, I got to do this, or I got to do that." I'm
Mm.
like, try and come up with I tried to come up with a framework that could help them stop worrying about this. I had someone who's like worth, I think it was worth like $4 or $5 million. He's like, I don't worry about the grocery store prices anymore since talking. I'm like, you didn't have to worry about the grocery store prices probably yet decades ago, but like the fact that now you're actually changing your behavior is good. And it's like, don't sweat the small stuff. Focus on the things like, yeah, if you're in like, level 4, like, okay, do I want to get a first class seat, or do I want to just maybe get like an emergency exit row seat, right? If you're like middle level 4, that's a fairer question than one you should think about. Not, oh, do I get the premium? Do I get the cage free eggs versus the standard eggs? Like that's not even like, just get what you want. If you want the cage free eggs, get them.
Yeah, that makes sense. So that's the 0.01% rule. What is the
Mhm.
1% rule?
So similarly, the 1% rule, 0.01% rule is for spending. The 1% rule is for making income decisions, right? So if you do 0.01% times your net worth, that's usually a very small number. It's how much you're spending. For income decisions, I think this is very helpful, especially if you're like a freelancer or someone who has kind of like you're always evaluating income opportunities. If you have a 9 to 5 job and that's your only income, this is not as helpful, if I'm being honest. But the idea is take your net worth, multiply by 1%. And if this income opportunity, the side hustle, whatever, is not going to kind of create at least 1% increase in your net worth, then you shouldn't do it, or you should just reconsider it maybe, right? And so I think there's people like, oh, I'll take on this client. And after all the work you do and everything, you're like, wait, this client is actually not even going to move my net worth by 1%. Why did I do all this? And so it's not a perfect rule either, but it's made as a way, as a secondary check on the thinking you already have about something. So you may feel a certain way about a certain decision. Do I want to take on this side job? Do I want to do the side hustle? Do I want to take on this client, etc.? And you're like, I'm not sure. Well, is there a mathematical framework I can use? Yeah, like do 1% of your net worth. Is that person or is that opportunity going to at least increase that by 1%? Of course, time matters too. If someone said, hey, you can clap your hands and I'll give you $100, like everyone would do it because it just takes basically no time. But like in the grander scheme of things, think about how this framework can help you with income decisions.
How does thinking about the opportunity cost of time change as you go up the ladder?
I think as you move up the ladder and like you're in theory, like you're investing more, you have more assets, those assets are throwing off more income. You have to really think a bit more about the types of income opportunities you take on. The types of is this job worth my time? And this is even in your own career. Like imagine you get to a point you're in, this usually happens for people, I think, in level 4, because you get to a point where your investment portfolio could be earning more than you, and even by a considerable amount, where like what you do on the investment front is far more important than what happens in terms of, your job or something like that. And so I think thinking about that is very important because now like the opportunity cost of your time is going up. Now, I'm not saying you don't want to overdo this, right? I think Tim Ferriss recently talked about this where he's like, you can put a value on your time that's super high and you're like, oh, my time's worth $1,000 an hour. And if you view everything in your life that way, then you're gonna, any sort of second of something that's not optimized, you're gonna like freak out or you're gonna it's a bad way to go through life. So I'm not saying to do that. I'm just saying when you're thinking about things like, oh, should I take on this job? Do I need to keep working? Like, what's the point? Like, all those types of questions should be related to the opportunity cost of your time. Not like, oh, should I go to my child's birthday party? Oh, I'd rather just, go work and I can make, $1,000 or something. Like, I don't
Right.
want you to start making those trade-offs, but I think the
Yeah.
trade-offs that do matter are like income decision versus another income decision. That's where you want to really think about those things.
You look at a ton of data in the book. How strong is the relationship that you observe between income and wealth?
I consider the strongest relationship in personal finance. And I know you guys have had people on the show that talk about expense management, and I do think it's important. I don't want to say like expenses are nothing, but if you just look at the data, like it's very rare to have high income and low wealth or low income and high wealth. And it's like
Mm.
the data is overwhelming. Like I tweeted something today, 95% of US households with an income over $200,000 have a net worth over $200,000. So anytime someone's like, "Oh, income doesn't matter. I know someone that has a high income and they spend it all." They're in the 5%. And don't get me wrong, I'm not saying they don't exist. I'm not saying that person's lying. I'm not saying that. I'm just saying that's the 5%. I would rather focus on the 95% and the thing that's
Yeah.
probably actually going to help you, which is your income. So I talk about this concept and I still get so much pushback on it. Like people are still like, oh no, it's because you're buying too many lattes, is this and that. And I'm just like, where's the data that supports this? I'll be the first person to shut up and say, you know what, I was wrong. I have not seen the data to support it and no one can show me. And every data set I've looked at shows a very, very high correlation between income and wealth. Now, someone's going to push back and say, "Well, Nick, if you have a lot of wealth and it's invested, it's going to be creating a lot of income." Of course, this is like a flywheel, right? You have higher income, you save it, you invest it, it creates that's now wealth. That wealth throws off income, right? It creates a flywheel where more income creates more wealth, which creates more income, etc. So if that's your counter argument, then I'm like, that's my point. Like this is exactly true. Like the wealth is creating the income and vice versa, right? And so that's all I'm trying to say. I'm not saying expense management doesn't matter at all, but if you have to think about what am I going to do over the next 5 years, I think your spending is not the place to spend all that time, and it's more of your income.
Speaking of data, how common is it for households to actually climb the wealth ladder?
So depends over the time period. So I have this data here. Give me 1 second. So I think it's I looked at 10-year and 20-year periods. And this data is different. So most of the data I talk about is from the Survey of Consumer Finances, which looks at like household snapshots, like just different households over time. There's another study called the Panel Study of Income Dynamics, which follows the same set of households over time. And I use that data to see, okay, if I see a household today and I look at them in the next snapshot, like in 10 years later, or that's probably two snapshots later, where are they? Are they in the same wealth level? Are they up, down, etc.? And so over a 10-year period, about 20% of households will increase by at least one wealth level, and 3% will have increased by two wealth levels. And over a 20-year period, about 33% of households will have increased by one wealth level, and about 5% will have increased by two levels. And so you're seeing there is upward mobility, even in the United States, despite what people say. And there's not I mean, it's good mobility, but you're seeing even, this is not just mobility like, oh, I gained wealth. This is, I gained enough wealth to get into a new level. And so for some of those people, that's going to be a marginal increase. For others, it could be a 10x or more jump. For those that went up two levels, their wealth went up at least 10x over a period of, a decade or two.
What about the other direction? How common is it for households to fall backwards on the ladder?
So regardless of time period, the downward mobility is about the same. So there's about a 10% chance of falling down a level within 10 years or 20 years. So that's actually kind of good. It shows that there's not like necessarily like over a longer period of time, there's more downward mobility. It's about the same. And then going down two levels, it's going to be about 2% of households. And so once again, going down a wealth level is not necessarily always the result of like something really bad happening. I think it could be there's some people that had, retirement, you're in retirement, you pull down your money. Could happen, you fall down a wealth level. It's not necessarily a bad thing. You expected that to happen, right? There's also cases of, divorce. Two individuals are in a household, they divorce, they have to split their assets, and then you have two individuals possibly at a lower wealth level, right? You take anything multiplied by 0.5, you could see how you could fall down a level. In addition, there's like investment things that can happen. If you have a lot of your money, let's say you have a business and almost all of your net worth's in that business and something bad happens to it. We go through a COVID-like scenario. You own a bunch of restaurants. You could see how you would fall down down a level or two. So those are examples of how that happens. It is rare though, which is the good part. And so once again, only about 12% of households will experience a downward shift in level over a 10 or 20-year period. But what that tells you though is most people actually stay in the same wealth level over a 10-year or a 20-year period. Most of them will be in the same wealth level. That doesn't mean they didn't build wealth, but they didn't build enough wealth to jump out of their level, right? So even in I think this is very common in like level 3 and level 4, because once you're in these levels, like especially level 4, it's the hardest one to get out of. I think it's something like 64% of households that are in level 4 today, or at least this is based on the historical data, 64% of those households will still be in level 4 a decade from now or 2 decades from now. So one way or the other, like it's very difficult to break out of these levels once you get there, because the strategies that get you in there may not be the same as the strategies that get you out. And we can go into that later.
I'm curious, Nick, if you have any idea which level might be most common to fall down.
It's actually so once again, there's limited data on this because the panel study income dynamics doesn't have too many households in this level, but it's technically, based on the data I have, level 5. So those with $10 million to $100 million are most likely to be in level 4, $1 to $10 million of all the levels. So of all of them, anyone that's most likely to fall down, it's technically level 5. Why do I think that is? Divorce, as I just mentioned. I just talked about the concentrated holdings. Like if you have a business, all my money's in this one business and it's worth 20 million bucks. Right now you're in level 5. Something happens to that business, you could see most of your fortune wiped away. So that's what we see in the data. Once again, there's not enough households in this data to really be like 100% definitive, but based on what I've seen, that's what the data looks like, which and kind of, it makes sense, right? Like you've seen, how do these people that are billionaires go to zero? It's like they bet everything on one thing, or there's fraud in their company, or there's all sorts of weird things where they're not diversified. And I think concentration is fundamentally the issue there.
How does the composition of wealth change as people move up the wealth ladder?
So in general, there's like this trend from like, let's say levels 1 and 2 to like levels 3 to 4 to levels 5 to 6, where the main assets that people own in levels 1 to 2 is mostly like their car, and then it starts to become their home by like levels 2 to 3. And then as you go into like levels 4 and 5, it starts to become their retirement accounts, stocks, things like that. And then 5 and 6 is where you're starting to see private business ownership, so like equity in your own company, or you have equity in a startup that kind of got very got very big and either sold for a lot of money or is just worth a lot of money. So that's what we tend to see in the data. And in general, this trend is like from less income producing assets to more income producing assets over time, right? So of those in levels, 1 to 3, less than 25% of their assets are in income producing assets. So, and by the way, your home is not considered an income producing asset. Your primary residence is not considered one in this instance. Compare that to levels 4 to 6, and over half of their assets are in income producing assets. So that includes your retirement accounts, real estate, stocks outside like a brokerage account, and private businesses. And so when you just look at that over time, and this was in chapter 3 of the Wealth Ladder, I'm walking through every single asset class and just showing you, okay, here's all the levels and here's the distribution of the percentage of their assets in each level allocated to that particular asset class. And it's interesting because obviously, like for those lower on the wealth ladder, like they just don't have money to go and buy stocks. They don't have money to do all this stuff. And so it's very obvious. But as they do start to get money, you start to see, okay, they buy a home. And then after they buy a home, then they have a retirement account, and then they start to own stocks. And then maybe they even have a business, right? And so it's kind of that progression up the wealth ladder, and it makes it very useful for those that are kind of looking at these types of things.
So what do you think the key takeaway would be for the listeners from that data of shifting wealth composition?
Yeah, it's more income producing assets all the way up. And like I wrote about this in the first book in Just Keep Buying. I said, the continual purchase of a diverse set of income producing assets. I wrote that back in 2022, did not have this data yet. And looking at this data now, I'm even more convinced of that, because there's one of the charts in the end of chapter 3 where I take all this together and I say, okay, look at just the percentage of income producing assets for each wealth level, and it just increases in every single one. Level 2 has more than level 1, level 3 has more than level 2, etc., all the way up the wealth ladder. And so that's kind of my main takeaway. It's like the people that have the most wealth also tend to have most of their money not even just most, they have more money, obviously, but like a higher percentage of their assets are in these types of, asset classes that are income producing than those lower on the ladder.
Yeah, it's interesting. It kind of makes sense, right? Because like a vehicle and a house are kind of fixed, and there's variation in value. I mean, obviously you can get really expensive houses, but someone with a medium or moderate level of wealth is probably not going to have a crazy expensive house, and so the rest of their assets are going to go into other stuff. And then you have the flywheel effect that you mentioned earlier, where that those income producing assets are going to increase in value over time. All makes sense. Yeah. Okay, so a big part of your book is going through the strategies of how you can get from one wealth level to the next, and that's probably the most interesting part of the book, which I think was the point. Can you talk about the strategies for moving from level 1 to level 2?
Yeah, so the strategy in each level is going to be different because of obviously the starting point. And so I think the obvious strategy that most people would say in level one, once again, you have less than $10,000 in wealth. Let's say you could even be in debt. It doesn't matter, just less than 10K net worth. And I think the solution there is to get to safety of some sort. And so obviously you're going to hear people say, get an emergency fund, financial safety. My kind of more expanded way of thinking about safety is, who do you have in your network? Do you have friends? Do you have family that can help you out while you kind of build that safety? And then you can help them out later, help other people out like in your network. And I think that's really important because we always like to measure wealth in very, financial terms and like, hey, what's on your balance sheet? But there's a lot more wealth out there in terms of networks, friends, family, as I said, that can really help you kind of get out of a dire financial situation. And so that's what I would say to focus on. Of course, like everyone knows, oh, I need to get an emergency fund. Like that's pretty out there. That's not a cutting edge idea. I think the thing that's a little bit different here is like, what are the other types of wealth I can rely on to get myself out of this? And this is a very common thing in the third world. Like there's this great book called Portfolios for the Poor. And these people are the best budgeters on the planet because they have so little that they have this network of borrowing they do and okay, I owe this person money, and they even do stuff that doesn't even make sense to someone. Like if you know mathematics, it wouldn't make any sense, but it actually makes a lot of sense behaviorally. For example, they will take out debt at like maybe not a crazy interest rate because they know if they don't do that, they won't save money. And so they take out debt as a forced savings mechanism because if they just had a bunch of cash sitting there, they would just spend it all right away. Right. And so there are behavioral tricks that, and it's not everybody that does this, but there was just some shocking things you read this, you're like, oh, that's very interesting. But just a lot of ways of thinking about budgeting and how you get to safety and using your network to do that.
Where on the ladder does pursuing education become really important?
From a financial perspective, it's definitely level 1 and probably most important in level 2, because by the time you're out of level 1, you can kind of say, hey, I have a base of safety and I can use that to kind of now invest in myself. And once again, I'm not saying that this is not true, for example, of like high schoolers going into college. Like a lot of these people don't have $10,000 in assets. I didn't either. But I think through my family, like I've never been in level one, not because even though technically my net worth was below 10,000 when I graduated, like all through college, but through my family, I would say as a proxy, I was at least in level two, and some people are even higher than that. And I think so when I'm thinking about education, I'm saying like, hey, you're in a spot where you can take this risk. And even if my education didn't pay off, I still would have been fine. I could have come home, stayed with my family. I could have lived at home and got a job and done whatever. That's not true of a lot of people. And so for those that aren't in that situation, you kind of have to get to some sense of financial safety before you can really start investing in your education a bit more. And it's unfortunate, but I think that's what's true. Now, once again, that's the financial side of education. I think education from a spiritual or just personal growth side is important
Yeah.
regardless of your wealth level. If you just want to learn more, I think that's great. But if we're just talking like, oh, what's the financial payoff? It's the most important and definitely in level two, because that's where you're either early in your career or you just need skills to kind of get out of that level where you can really change the trajectory of your life, right? If you get a good paying job or something, that can get you into level three or level four. Just all you need is time now, right? And so I think education is the thing to think about. And once again, education is a very broad term because I'm not just talking college degrees. You can go and do, there's blue collar work, there's trade schools, there's other types of skills out there. Learn sales. Like I think of all of the skills out there that are going to be valuable in the future, I think sales is still going to be one of the most valuable because AI is not going to be able to do it. Like I don't really imagine robot realtors and things like that. I really think people are going to buy from people. AI will do a lot of other research and other things that are really important, but I still think sales is going to be an incredibly valuable skill. And if you get very good at it, like the sky's the limit. You can sell, luxury real estate in New York City and make a killing doing that.
Hmm. Okay, so that was to get from level one to level two. We're talking about budgeting and social networks. Is that right?
Yeah,
And then level
safety.
safety, right? Okay. Then level
Yeah.
two to level three, education. What does it take to get out of level three?
I think that's where investing really starts to play a bigger role. And obviously, time is the big vector in all of this. Like if you have time that with enough time, you can just, you'll saving money, investing, etc. That gets you into level four, etc. But yeah, I think it's really where investing starts to take off. And it's not that investing is not important in level one or level two or anything like that, but just the payoff and the impact just is literally 10 times smaller, right? Like if you say, oh, I have $10,000 invested. Okay, let's say you have a 10% year, that's $1,000. I mean, that's not nothing, but now you have $100,000 invested and now that's 10,000, right? It's like at some point your portfolio starts to compete with you in terms of how much you can save, right? And I think that is the big unlock. And especially by the time you're in level four and get deep into level four, it's probably going to start earning more than you, right? And so thinking about that is like you're really like your financial assets, you're like kind of rebuilding yourself as like a financial asset equivalent. Like you can imagine like, okay, I'm trying to rebuild a worker that goes out and earns money for me, right? And so in level two, like that worker doesn't make that much money. Really, like your spending is going to be far more important. How what your income decisions, how you do your career is going to be more important. By the time you get to level three, that little financial asset equivalent's a bit bigger. And now it's probably maybe not making the same as you, but it's really helping. It's like, wow, that's actually really, it's like having an assistant that's there earning you money. And then as you get deeper into level three and especially into level four, that thing actually starts making more than you. And
Yep.
that's where the real unlock is. And so I really focus on investing in level three. It was why, I wrote Just Keep Buying for like the proverbial level two to level three household that wants to get into deeper into level three or into level four. And I fundamentally believe that's it. And so it takes a long time and you got to save and, hustle away at that. But I think that is the way to do it. And there's a ton of data that shows it can be done.
Hmm. You talk in the book about having a side hustle. Um, would you worry about a side hustle distracting people from their like main career?
Oh, definitely. I probably should have mentioned that a bit more. It depends what your career is and kind of the trajectory. I think in my case, my side hustle is like I blog. I've been blogging on the internet for 9 years. I've written a few books, etc. So I did that because I had hit a cap in my job. Like there was
Mm.
no way I was gonna on my old job, right? There was no way I was gonna earn more. Like I'd have to go get an MBA or a PhD. So I was capped out. So if you're in one of those positions where like, hey, I'm gonna get 3 to 4% raises for the next 20 years unless I do something else, then that's where a side hustle really isn't as much of a distraction. If you're in a career where like, oh, I could get a promotion and then this happens and then like that's a different story. So I think you have to really think about your situation. And I don't think a side hustle is necessary. I think for some people where maybe they're in a industry or position where like, hey, for me to get to that next level, to get a real big jump in pay or anything like that, it's just not going to happen, or it's going to take much longer than I thought, then maybe a side hustle can make sense. And I also enjoyed it too. I think there's also some personal enjoyment in side hustles because people do them because they love them. I'm guessing that's not always the case, but in my case, that was true. And so when you're thinking about should I do a side hustle, yes, think about is this going to distract from my main career and could that send me off on the wrong path? And then also think about like, do I enjoy this thing? And that's another piece of it.
Yeah, it's interesting. Your side hustle, I think, led you to change careers and
Hmm.
go into something that has much bigger upside. I asked the question because I've never done a side hustle. The closest thing I've done is the content stuff, but I did that as part of my career.
Hmm.
So we kind of took different paths to get to a very similar place, I think.
Yeah, exactly. And so like I was doing this on the side and then I, got recruited to join a wealth management firm. And so this is not, technically through them, but yes, it does help bring in clients here and there. And
Yep.
so that's helpful in its own right. But, it's just interesting. It's that you have that alignment. And so it's nice to
Right.
have that. And so yes, now there is more potential in my actual career than there was before. But like I started this on that side path and now like the side path kind of veered into the main path somehow.
How important is controlling spending in level three, either to get out of it or to even stay in it?
So the biggest expense for those in level three in general is their home. And you kind of see that in the data in terms of their assets. It's like of all the asset classes they own, their primary residence is the largest one. And when I was looking at data on like some of the mobility data in terms of let's look at households that start in level three today, and then 10 years from now, they're still in level three, and compare those households to those that start in level three and make it to level four. Like, what were the differences? One of the biggest differences is those that made it to level four had higher income. So once again, income is like one of the big things. But the other thing I saw was that the spending between these two groups was almost identical. So even
Hmm.
though the people that made it to level four had more income, and so that obviously helped them save more, the people that didn't make it to level four spent almost as much as the people that did. And so like there is a keeping up with the Joneses. So here's an example where like spending can matter. And I do start to see that in the data. But once again, if I had to pick, if I'm talking to the person that's in level three and I think they're going to still be in level three in a decade, I'm not going to tell them to like cut their spending. I'm going to tell them to grow their income because it's going to just make it so much easier because they grow their income, their spending's not going to go up that much, at least based on the data I saw. Those that went from level three to level four did spend a little more than those that stayed in level three, but they didn't spend that much more. Like they're spending almost the same amount of money, but they're making so much more. And so that's where I'm like,
Mm.
that's where the wedge is. It's in making more money. And so I know to some people this is going to sound obvious, but at least in the United States and the financial media, this is not an obvious point because there are still so many people that beat the spending horse, just keep on bringing this argument up over and over. And I'm not saying it doesn't matter for a small subset of people. It definitely does. But for the vast majority, it is the income that is the lever.
Hmm. Okay, so earning and investing is going to get you into level four.
Hmm.
What does it take to get up to level five? Because the jumps in wealth start becoming, I mean, that's the point of the ladders. They start becoming really big.
Yeah. And so to get to level five, this is I call level four the no man's land of wealth because once you're in level four, and once again, you don't need to get out of level four. You don't even need to, for some people, you don't even get out of level three, right? I think in certain places in the world, for especially in like Europe, because the social safety net is so much better, I think level three is like the enough level in like Europe. I think in the United States where healthcare costs are much higher, and I would say Canada is probably between, I would say Europe and the US in terms of how I would think about it. So you probably need to be level four even in Canada to kind of really feel that financial like independence and everything. And so why I say level four is the no man's land of wealth because the stuff that got you in there is very unlikely to get you out. And I can
Mm.
just do some simple math, which I brought from the book that demonstrates this. Imagine today you have an investment portfolio. I'm just making it very simple. $1 million investment portfolio. You've already done that, which is an accomplishment. So congrats on doing that, however long it took you to get there. It's earning 5% a year. Let's assume this is inflation adjusted, right? And you're adding $100,000 a year. How long does it take you to get to 10 million? So how long does it take you to get from the beginning of level four to level five? The answer is 28 years. Take your
Mm.
financial calculator, run it yourself. You'll see 28 years. So it's going to take you, that's almost 3 decades of grinding it out, saving $100,000 after tax, a considerable amount of money, while earning 5% a year after you've already made $1 million, right? So you can see the math is not your friend
Yeah.
once you're in level 4, right? And even if you're like, well, Nick, I'm going to save even more. I'm going to save 300,000 a year, like an insane, like you're almost making probably, you're probably making $700,000 a year pre-tax, right? Even then, it takes 17 years, even
Mm.
with saving 300K a year, 5% return starting with a million, right? So you can see like that standard 9 to 5 job, save, invest in your 401k or your retirement account, whatever, and let the markets do the thing for you is just not, it's not going to get you there without a very long time and grinding for a long time. So I think the better solution, if someone really wants to get into level 5, is what are those people that get into level 5 and how do they get there? Besides the celebrities, athletes, entertainers, put those people aside. Let's assume you're not them. It's business owners. It's all entrepreneurs. And so you basically have to start a company and sell it for, tens of millions of dollars and you have most of the equity. Or you join a company very early that's like a startup and it sells for hundreds or millions or billions of dollars. And your net take ends up, you're now in level 5. And so that's why, if you look at the data, like the vast majority of those people have most of their money in business interests, and especially in level 6, which is 100 million plus. It's just overwhelming, like what the data shows on that. And so I was just trying to emphasize that. If you want to do that, that's the big decision. Do you go out on your own, start a business, or do you say, hey, you know what? I'm comfortable not doing that and just kind of doing my thing here. Or you could even take your foot off the gas. That's another option that no one's thinking about, which is the whole coast fire idea. It's like, hey, I've saved enough, or if I stopped saving right now, I would be able to get to retirement. I just need to cover my current expenses. And so I think that's the big decision point. And I think a lot of people rationally say, hey, I'm not going to keep grinding just to build more wealth. It's not going to really improve my life. And they pull back. And I think that's the right thing to do for a lot of people. And I unfortunately don't think enough people do that.
So someone finds themselves in level 4s, that's the $1 to $10 million rung. What kinds of things knock people out of that?
So we already talked about some of them earlier, which is like divorce, like
Divorce.
personal
Yep.
things of that nature. I think if you're not diversified, like some bad investments, or you have most of your money in one thing. I have friends that have a lot of their money in tech. They're like in the Qs or even a levered Q, and they have like 50% of their assets in there. And they're like, hey, it's going great. And it is going great for them. But if that turns, like we saw what happened in 2022, if that had extended further, like it would have been really bad. And I actually think the 2022 bear market was going to get much worse. Just this whole like chat GPT happens at the end of 2022, and that's been the bull market ever since. We're off to the races. And so if that doesn't happen in that way, like who knows where tech valuations would be today. And so yeah, that's if I had to pick what are the two things, it's going to be some sort of like in the US especially could be health issues, but those are rare and they happen, but they're rare. It's going to be health issues, divorce, and, over concentration, right? Because it's like, how do you lose wealth? Like, how does that even happen? You're not going to be spending down necessarily. That could happen if you're in retirement. So there is that class of people who are kind of level 4 and they pull down. But if you actually look at the retirement data, most retirees do not spend down their portfolios. They just don't do it. They spend their income, they spend up to what their investments return, but they just don't withdraw. Like it's like 1 in 7 retirees actually pull out that have actually have a portfolio. So we talk so much about the 4% rule and no one uses it, kind of sadly, but that's at least the data I've seen. And so I'm like, I trust me, I've looked at all these retirement things for so long, and I just have not seen any data that a large percentage of people use the 4% rule.
Wow.
Yeah, there's a Canadian paper showing the same thing. I'll dig it up and send it to you, but it shows
Oh,
basically the same thing, that retirees in Canada spend way less than they could.
yeah, no, that's great. I knew you'd have a paper, Ben. So
Yeah.
that's great. The fact that the Canadians and the Americans think the same on this is like, yep, that's probably true then. So
Yeah.
I don't know, and I get it. Like you're worried, you're like, oh, I don't want to spend out all my money. A lot of people aren't well versed in the 4% rule and know all that. They're like, I'm going to spend it, and then there's gonna be a market crash, and then I'm going to go through like, and they also, a lot of people, I talk to a lot of retirees and they're like, I just don't want to spend money. Like I have nothing I want to spend on that's going to make me like, they don't want to fly private. Like I don't need to do all that. Like all these things that you're like, oh, spend it on this or that. Like they don't want to do. They don't want to get and travel to the other side of the world and be on a 10-hour flight or something. Like they just can't be bothered with a lot of this stuff. And so I think, they're very content and they just don't want to spend money. And so it's really hard to be like, oh, spend more if like they don't want to.
Yeah. I think a lot of it's the separation of income and capital too,
Mhm.
where people will spend their dividends, but they just don't want to spend their capital, even if that's
Yeah.
wrong. We can tell them, hey, that's wrong. You could spend more, but people don't want
Yeah.
to hear that.
Live off the principle is such a great line, and it works. Or I'm sorry, live off the income is such a great line, and so never
Yeah,
touch the principle, basically.
yeah,
So
exactly. What are the downsides of reaching level five when you start to get into that more extreme wealth?
I think I'll bucket level 5 and 6 together. It's just like you have to think about all the different ways that your life will change. Like, not just like, okay, yes, I have more money, I have to manage it. There could be the stress of managing the wealth. That's financial in some ways, but like the loss of possible trust. Like if you meet someone and they know you're wealthy, it also depends how if this is stealth wealth or not. If you're known as being wealthy, I think it changes it a little bit, or people could like look you up and would realize how wealthy you are. Because then you'll never know, does this person like me for me, or are they just like after me for my money? This is where like old friends are really important because they liked you when hopefully you weren't, in level 5, etc. Right? And so you got along with them then, which is great. And so I think that's one thing. I think family dynamics change a bit more because like maybe there's an expectation because you have so much money. It's like no one in maybe if you're like kind of low in level 4, no one's like, oh my gosh, you have all this money and you're rich and you can do all this stuff. But if you're in like level 5 or even deeper into level 5, like people are like, you could do tons of stuff with your money, right? And so there's like the social almost pressure or maybe expectation of like, oh, what are you doing with that money? Or maybe you should be donating it or this or that. So there's a lot of these things that happen, like even your own motivation. Like when you're level 4, you're like, okay, at least I can still grind to do more, but by the time you're like deep into level 5, it's like, what is you have so much money, you would probably never consume it. It really changes your motivation to work, all sorts of things. So I talk about all these in the book and the different ways that these can impact you. Now I know what some people are going to say, like, it's first world problems, world's tiniest violin. Who cares about this stuff? But I actually believe this. I do believe more wealth can actually ruin people's lives, and I fundamentally believe that. I know some people will like, oh yeah, I'll agree with that, but like maybe inside they're like, I don't actually agree with that. But I really believe there's a lot of people out there that more wealth had actually made them worse off than if they had never had that wealth.
Yep, I believe it. We did a whole episode, episode 145 of this podcast with Jennifer Risher, who basically wrote a book about exactly that, about the challenges of extreme wealth and all the
Yeah.
ways it can affect social dynamics. And yeah, it's a real problem. It's a funny thing to call a problem,
Mhm.
and I think people are quick to criticize calling it a problem. But I mean, it's a real thing. There's a different type of struggle that people in those situations have.
Yeah.
How much do you think people's lifestyle changes when they go, say, from level 4 to 5 or even, 5 to 6?
I think it's more of a personality thing than that's going to determine if there's going to be a lifestyle change. There's certain types of people that are like, I will never spend that. Like, it doesn't matter what's in their bank account. They will just never spend that much money to, like, let's say, fly private. They're like, whatever, 5 grand an hour, 10 grand an hour. Like, I'm not going to do that. Like, they're just not going to pay that. I think there's others who will say, okay, what happens when you start to get into level 5? That's where you can start to fly private. There's actually a guy named Preston Holland. He's like the private jet guy on Twitter, and he has really good data on this. There was a MoneyWise episode where he's talking about like the the middle of the bell curve for where people really start to fly private a lot is about $20 million in wealth or $2 million in like annual income. So these are, I mean, obviously these are very like far right tail exceptional people in terms of either wealth or income, and so that's where we start to see it really they start to show up at around $10 million in wealth, but they really are showing up the most at, 20 million bucks. So that's the kind of consumption change that can happen. Once you get into 100 million, now you can start talking about like yachts and all sorts of other things. Obviously, it depends on the size of the yacht, et cetera. But like you can really, there's no way to stop your consumption if you really want to go all out. You can start buying companies, you can really start impacting people's lives in a much bigger way. So I think that's the big difference is like, especially those in level 5, if you had a business or you sold a business, like you had the ability to influence a lot of people's lives that you had the business with. So I think it's another thing to think about, not just consumption, but like how your money can impact society just through the
Mm.
decisions you make.
How long does it typically take people to reach each rung on the wealth ladder?
So it really depends. So I have some data in chapter 10 which looks at this in terms of like, okay, I don't have, because I don't have an annual snapshot, I can't be like, okay, it takes 4.7 years or something. I have them in 5 year snapshots. And because of that, I can say, okay, what percentage of people started in one level and then got to another level over time, right? And
Mm.
so let me give you the exact, I have the actual page number here. So for example, on page 153, there's a matrix which shows the starting wealth level on the each one of the rows and then the ending wealth level along the columns, right? So you can imagine is like a matrix, right? So for example, 46% of people that are in level one will still be in level one 10 years later, right? 30% will have made it to level two, 22% will have made it to level three, et cetera. And so you can look at this little matrix here and do it over a 10-year period, and I have it over a 20-year period as well. And you can see what percentage of people, so you can say, hey, I'm in this level today. What's the probability I'm going to be in that level? And it only goes to level five because we just didn't have any level six people in the data, and they're very hard to find. But either way, you can kind of run the math and run the numbers and say, okay, this is the rough percentage of, the chance I'm going to be here in 10 or 20 years. And I think once again, for the most part, over a 10-year period, it's going to be what I say, about 24% of people will have moved up at least one level. Over a 20-year period, it's going to be about, 34%, I think. So something like that. So it's like roughly a fourth will move up over a decade and a third will move up over 2 decades. So that's the thinking. So if you're like, okay, well, where am I at today? It's probably going to take at least 10 to 20 years to move up a considerable number of levels. So it does take time. And unfortunately, there's no shortcut to that. And I think the whole point of that chapter was to really show that idea and say, hey, look, it does take a long time. And here's the data showing that. And so there's all these get rich quick things out there, obviously, that we've all heard about. But I really wanted to show people like this does take more time than you think. And here's the data to prove that. And so despite what your favorite Instagram influencer, whoever says, like the data shows it takes more time than most people think.
I think you showed a pretty clear relationship between age and wealth too, right? Where
Mm-hmm.
the people in each bucket just tend to be older than those in the bucket below them or the ladder rung.
Yeah. So the median age in each wealth level is as follows. Now, once again, you could think about if we just said what's the median age in the United States, that should be like the level one age because all else equal, like everyone, in theory starts in level one, right? Or that's like the base level. So the median age in level one is 42, which is probably close to what the
Hmm.
median age in the whole United States is. Um, in level two, it's 44. In level three, it's 54. By level four, once again, which is $1 to $10 million in wealth, it's 62. Level five is 64 and level six is 66. So as you can see, it's
Hmm.
it's monotonic. It's always increasing, right? Throughout each level, like that the median age goes up, but you really see the biggest jump from, two to three, which is 44 to 54, and then three to four, which is 54 to 62. And so if we just let's just imagine a hypothetical median person, right? So if you're in level two at 44, it takes you roughly 10 years to get to level three, right? And then from level three to level four, it takes another, 8 years. I know that's not exactly how this works statistically, but just, if that's the median ages are about that far apart, you can assume that it's going to take you 20 years to go from level two to level four, all else equal.
Hmm.
So that's just it's another way of thinking about this, but it's something that you could in theory use.
What do you think those data say about the importance of time and just like staying in the game to accumulate wealth?
I mean, I wanted to show the data in a way that was like, hey, set the right expectations because this is a long journey. It really does
Right.
take a lot of time, right? Like people that go up like more than two levels within a short period of time, it's very rare. And the only people I know that have done it are those that had a business and they sold it, end up in like level six. And so maybe they would have started in level two or three and they end up in level six. But still, usually they were working in that business for, half a decade at least, if not longer. And so thinking through that, like I just want people to know how long this actually takes so that when they are on their journey, they have to realize it's going to take time as well.
What does the typical millionaire household look like?
Okay, so I actually pulled some data for you guys outside of just the book. Some of this was in the book, but I pulled a little bit extra just so we can walk through it all. So
Hmm.
the median age, and when we say millionaire household, I'm just looking at level four, which is 1 to 10 million. Technically, I would have to include, level five and six, but let's just say level four to make this a little bit easier. Median age is 62. The median household income in that bracket is about $200,000. The
Hmm.
median net worth is actually 2 million. So
Hmm.
what does that tell you? Okay, even though like level 4 is 1 to 10 million, half of those people have less than 2 million. The other half are 2 million to 10, right? And so you can think obviously home equity is a big piece of that. So liquid, what's the median liquid net worth in there? So drop home equity, drop retirement. It's about 700K. So about 33% of their net worth is liquid. So if you're in level 4 right now, you can be like, okay, how much of my net worth is liquid? And on, the I don't want to say on average, but the median household or median liquid net worth in there is about $700,000. In terms of their asset breakdown, the median, millionaire is going to have about 32% on average in their primary residence, about 24% in their retirement accounts, 12% in stocks outside of their retirement accounts, so in stocks and mutual funds, about 9% in other types of real estate, 9% in business interests. Of course, this is on average. There's going to be a lot of households with zero, a lot of households with, a considerable amount in business interests, 6% in cash, 6% in something else. So a very small percentage in some other non-asset that I haven't listed here, and then 3% in their car. So if you say,
Hmm.
on a $2 million household, which is the median net worth, 3% in vehicles means your vehicles are worth about, 60K or something, right? So that's kind of the breakdown of what a typical millionaire household in the US looks like. And once again, you're going to have people on all sides of that, right? Like 5% of millionaire households are in their, or 5% of households in their 30s are in level 4. So it's a very small percentage. About 15% of those in their 40s are in level 4. And once again, this is in chapter 10. So just thinking through this data of like, what does the typical millionaire household look like? It's someone who's a little bit older. They're on the verge of retirement. They're probably going to start pulling from those retirement assets. And yeah, their household income is about 200K a year.
Hmm. It's super interesting just to hear how the data breaks down and what that typical millionaire household looks like. How do you think people should think about enough, in quotation marks, when it comes to financial wealth?
I mean, I think this is the whole premise of the FIRE movement, right? It's like, what is your enough and figuring out what you need for financial independence. And so I think that's why level 4 is, if I have all the levels I think about, not just because I'm in level 4, but because I think this is where people have these philosophical debates, because you start to get to a point where even the typical person spending, by the time you're in level 4, depending like where you are in level 4, you'll have enough income to like live a decent life, right? And so where that is exactly is going to vary person to person, but it's usually going to be somewhere in the, let's say, $2 million to $5 million range for like most people. So you start getting in there and you start to think like, okay, that's enough to like live a pretty decent life, just off the income off of a portfolio of, let's say, that size. And so thinking through that is really the big decision you have to make in level 4. And so where is that enough? Every person, as I said, is going to be different. I think it's going to be somewhere in level 4 for most people in the US and especially Canada. I think in Europe, it's probably a bit lower because the social safety net's higher. The healthcare costs aren't as exorbitant as they are in the United States, et cetera. So, it's up to you really, but I think it's going to be, if I have to pick what is the enough level, it's going to be level 4, and probably just a mid-level 4 to maybe the later half if you really want to be conservative.
Hmm.
I don't think you need to get to level 5.
What other types of wealth do you think people should focus on building?
So I took this framework from Sahil Bloom, who came out with the book called Five Types of Wealth. And so one of them is obviously financial. And so the other types would include social, time, mental, and physical. And I think these are ones that are easily overlooked simply because they're harder to measure, right? Like you can go open your brokerage account, you can open your bank account and see a number. You have a scoreboard, so to speak, right? That you could use if you really wanted to compare yourself, all this type of stuff. You can't do that as easily with your social relationships, It's not just like the number of friendships you had, the depth of them. You can't just, I don't have a social scorecard, right? I don't have you can say, oh, maybe my health can be looked at or something, but even then, like, you don't track that. Maybe you see that once a year. It's not the same. So because of the measurement issue, I think it's very easy to overly focus on financial wealth, especially those that have done so well financially. It's like, oh, I'm doing well at this thing. This is what I do better than everyone else. And so you overly focus on it, and the sacrifices, you end up messing up other parts of your life as a result. So you maybe don't spend as much time with your kids. You neglect your health, right? You suck up all your time because you're like, I want to make more money. So you take every meeting, you say yes to everything. And next thing you know, you don't have time to do a lot of things you want to do. And so I think thinking about these other types of wealth, which is the kind of the main thrust of part 3 of the book, is where I start to really open this up, right? We start very broad talking about the wealth ladder. I get very specific talking about each level in part 2. And then part 3 is like, okay, what does this actually matter for? And what are the kind of bigger issues you need to think through as you're quote building wealth in your life? And so those are the 4 I would focus on is time, social, mental, and physical.
Yeah, that's good. Good framework. How do you hope that individuals and financial advisors who read this book should use it to improve their decision making?
I think it's going to be, most financial advisors, I don't want to say this across the board, but I think the typical clientele is going to be somewhere in that level 4 bracket. I think maybe high level 3, low level 4. Um, and that is where, as an advisor, you can really empower your client to think about these types of decisions. Like, okay, we have this level of income, you have this much net worth, like here's your house, etc. Like, what do you actually want to do in the future? Like, do you want to start a business? Do you want to like have a coast fire scenario where you pull back? Now, I know advisors are going to be incentivized to tell them, yeah, keep working, keep adding funds, right? So you get, if you have an AUM fee, especially like everything's incentivized to keep adding more to the system. I understand that. At the same time, there is kind of this fiduciary responsibility you could have of like, hey, we also need to think about like what's the thing that's going to make the client most fulfilled as well. And sometimes that may not necessarily mean maximizing their wealth. And so I think that's the big for advisors in particular, it's the level 3, level 4 types of conversations that are going to really help people. And I mean, there's also like, it's not that the level 1 and 2 conversations won't be helpful. That could help other people and their clients' lives, but it's just thinking about it more holistically. And for me, it's like, what is that framework and what's the decision we're talking about with the typical client? And it's going to be someone who's, high net worth, and they're having some sort of debates about what to do tax-wise, what to do with their job, whether they want to move, any, planning for their children, etc. These are all the types of decisions that roll into that kind of level 4 bucket.
So we have a twist on our final question for you, Nick. How did writing this book affect how you think about success in your own life?
I'm in level 4, and so many of the decision points I was thinking about personally were a lot of the decision points I was writing about in the book. It's like the same things that are happening to those people in level 4. I'm thinking about those things, right? I'm like, oh, do I go all in on writing? Do I like stop working a corporate job? I had thought about that. Do I stop writing and just do the corporate job and chill out and not have to worry about this anymore? Like, do I want to coast fire? Like, do I want to start my own business? These are all the things I've thought about. And so I think the bigger question that I eventually realized when I was doing all this writing and thinking about success, it's like I define success as a living life on your own terms, whatever that means. And so I'm still thinking through like, well, what does that mean? I think that's the bigger question for most people. Is not even just like, okay, if living life on your own terms is my definition of success, then like, what are the terms that I actually want? And what are the liabilities I want to take on, right? Like I've had people say, oh, Nick, you should start a podcast, you should start a YouTube, etc. And I'm like, that's great. And maybe I would be successful. I have no clue, but there's a lot of work that goes into it. You guys know this is not like I write once a week, and don't get me wrong, as hard as that is, it's relatively easy relative to putting together a podcast, editing, coming up with questions, finding guests. Like I think there's just so much more work involved. And so, there's liabilities to success that I think a lot of people don't think about. And I'm trying to figure out what are the liabilities I'm comfortable with. And writing one blog post a week for me and an occasional book is just enough liability to keep me happy. I'm still debating what are the things I would consider putting on my plate because something else has to come off the plate as a result. And so I'm trying to figure out that balance personally.
Great answer. Great to have you on again, Nick. Great to see you. Congratulations on a phenomenal book.
I appreciate it. It's always great chatting with you guys and Cameron. I know we go way back, discussing the Ritholtz of Canada as I called you guys back in the day. So it's been very fun, kind of going back and forth with you guys over the years, and obviously Ben watching you on the YouTube channel and everything. It's so cool. So definitely a fan over here in the States.
Awesome. Thanks, Nick.